somebody deliberately try to smack down the silver price, or did they just think it was too high? And obviously it was relatively high on that day, and they were just trying to take advantage of the high price. But if, there's two possibilities. One, they were going short, which is going to basically force them to buy back now, or they were selling a large position. But I can't see anybody wanting to sell a large position because all the fundamentals are in favor of it going up, with falling supply and rising demand from the electronics industry. And there's every year for the last 3 or 4 years an annual deficit. So I can't really see that a big silver holder would particularly want to sell at this point unless they have to raise cash for another problem. But there's no problems going on at the world. I mean, no problems like margin calls going on anywhere at the moment. So people aren't being forced into raising cash. So I don't think it was somebody being forced to sell. I think it was probably somebody trying to take a short position, as is written in that post.
Canadian journalist Clive Thompson has closely tracked silver's distinctive price behavior, observing a consistent pattern of consolidation followed by sudden upward spikes. Recently, silver stabilized in the $30 to $32 range before jumping to $33, reigniting bullish sentiment. It then surged past $35, sparking expectations of a rally toward the $38 to $39 range. Last week, silver briefly touched $38, demonstrating the typical sharp spikes followed by periods of consolidation that have come to define its trading behavior. The most dramatic movement occurred on Friday, when silver prices vaulted through the $37 and $38 marks per troy ounce, reaching fresh 14-year highs. This explosive rally was directly linked to President Trump's unexpected announcement of trade tariffs on copper, which triggered a rush to import silver into the United States. Market participants described the reaction as a scramble, as traders sought alternatives to the newly targeted metal. Thompson's analysis highlights silver's well-established pattern: periods of price stability followed by abrupt $1 to $2 gains that re-establish higher trading ranges. This cyclical behavior has been evident during silver's ongoing multi-year bull run. The metal surged from around $9 to more than $48 per ounce in under 3 years during the last major cycle, driven by massive global monetary expansion and heightened fears of currency debasement, which fueled investment demand. In 2025, silver has entered its 5th consecutive year of supply deficits, adding a strong fundamental backdrop to the technical momentum. The deficit is the result of sluggish mining output and rapidly growing industrial demand, particularly from sectors tied to clean energy and electronics. Unlike investment flows, industrial consumption has proven consistently resilient, giving the metal a dual support structure that continues to push prices higher. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We've been seeing for the last year or so these sort of still is stable for a while, then suddenly leaps up $1 or $2, and then comes back, and then it's stable, and then you think, well, I thought it was the rally starting, and then it's stable still. Then it leaps up again unexpectedly. So it's almost like it's testing the market to say, hey guys, what do you think of this? I'll jump up and see what you think. And then, of course, what seems to happen almost every time it leaps up, there seems to be a wave of sellers, which and then the price stabilizes at a certain level. More recently, it was stabilized around $30, $32, and then leapt up to 33. And everyone said, hey, 33, we're going to the moon. And it sort of stabilized there. And then it went up to above 35, and everyone said, well, 35, it's going to 38, 39, and then stabilized. And now we've just got above. I saw it one day, didn't we hit last week at one point, for a few seconds anyway, at least $38? Somebody deliberately tried to smack down the silver price, or did they just think it was too high? And obviously it was relatively high on that day, and they were just trying to take advantage of the high price. But if, there's two possibilities. One, they were going short, which is going to basically force them to buy back now, or they were selling a large position. But I can't see anybody wanting to sell a large position because all the fundamentals are in favor of it going up, with falling supply and rising demand from the electronics industry. And there's every year for the last 3 or 4 years an annual deficit. So I can't really see that a big silver holder would particularly want to sell at this point unless they have to raise cash for another problem. But there's no problems going on at the world. I mean, no problems like margin calls going on anywhere at the moment. So people aren't being forced into raising cash. So I don't think it was somebody being forced to sell. I think it was probably somebody trying to take a short position, as is written in that post. I think what happened on Thursday, then, if that was a person trying to take advantage of the market, what he probably assumed was that because silver had been rising, a lot of people had jumped on the bandwagon and had become silver bulls and had placed stop losses slightly below the market. So he probably expected by a massive dump of silver onto the market, he'd drive the price down, triggering all the stop losses, forcing all the longs to liquidate their positions. They would be liquidated automatically because of the stop losses, and he'd be then picking up the silver at the bottom of the market at a much lower price. That's what he obviously hoped, but it doesn't seem to have worked for him. Well, nothing ever moves in a straight line. So bull markets are always punctuated by these bear moments when things go down for a week or a month or several months. But clearly, at the moment, the amount of wealth being created by the government's borrowing and getting poorer it's off the radar screen in terms of percentages, and that wealth is turning up in the hands of people who can't spend it on other things. So what do? They invest it. Now that what does that mean? It means that the fundamentals of the stock market don't actually have to be very good. They can be quite poorly, but there's still going to be money pouring into either the stock market or property or gold or silver or Bitcoin or whatever you like. The wealth which is created has to find a home. Yeah. And I don't think it's going to be treasury bonds. According to the Fed Watch, the CME Fed Watch, there's almost no possibility of a cut at the Fed meeting at the end of July, 30th of July. They've got like 90-something% saying the rate will hold steady. And then the probability of a cut does shift for the 17th of September meeting to 57%. And then it's only a 0.25% cut. So it looks like if the market's right, if the CME Fed Watch is right, it looks like there'll be no cut in the summer at all. So M2 is going up sharply here, which means that that is definitely going to be inflationary. But obviously what it's doing is, amongst other things, it's boosting asset prices.
Thompson notes that one key development catching his attention is the apparent weakening of the U.S. dollar. For holders of dollar-denominated assets like U.S. Treasuries, this presents a double loss. Not only are bond prices declining, but the falling exchange rate, already down around 13%, is compounding those losses. The U.S. dollar index dropped more than 11% in the first 6 months of the year to 97, marking its worst first-half performance since 1973. Since President Donald Trump announced sweeping reciprocal tariffs on April 2nd, the index has fallen 7%, further weighing on dollar sentiment. The fragmentation of global trade and rising geopolitical turmoil are prompting both central banks and investors to move away from the dollar and explore alternatives such as gold, the euro, and the Chinese yuan. Since the beginning of the year, the dollar has lost more than 12% against the euro, mainly due to Trump's trade policies, which have narrowed the U.S. trade deficit but raised concerns about higher borrowing costs and fiscal instability. This environment of persistent dollar weakness has created a tailwind for precious metals like silver, as investors increasingly seek refuge outside of dollar-based assets. Research suggests that undervalued local currency bonds and foreign exchange markets in countries like Turkey, Chile, and Egypt remain attractive, with the potential for greater demand if the dollar continues to slide. Given current market dynamics, silver's recent breakout to 14-year highs appears less like a short-term anomaly and more like the beginning of a broader, sustained move. As the dollar continues to weaken, silver is finding stronger footing among investors looking for tangible assets with long-term purchasing power. Let's get back to the interview.
The one thing which stands out to me is that the dollar does seem to be weakening. So if you're a holder of dollar assets like US Treasuries, not only are you losing because the price is going down, you're losing because the exchange rate has fallen already by about 13%. I know that because just as an experiment, and not because I like it, I bought a fund called LQD. It's an ETF which follows investment grade bonds. And I looked at it and the price is more or less what I paid for it. But my bank says I'm losing 13%. I thought, well, I'm losing 30%. It's more or less what I paid for it. Well, the reason I'm losing money is the fall in the exchange rate, i.e. the dollar has collapsed. Yeah. And so I think that's, there's going to be an awful lot of people all around the world who will be talking to their investment managers saying, you bought me these bond funds 2 years ago. Why are they all showing losses? Yeah. What are we going to do about it? Yeah, I mean, especially Germany. I think they've allocated another $500 billion to the military budget, which is a huge amount. And yeah, clearly, Europe is saying we can't rely on America to be our ally necessarily. I mean, one still likes to think they would be, but if the worst comes to the worst, Europe is saying we've got to make a little bit more effort on our own. So that will obviously widen the budget deficits and means the governments have to borrow more. And if they borrow more, the government gets poorer. Someone else gets the money. Someone else gets richer. They reinvest it in other assets like gold, silver, stock market, property, whatever you like. Well, if Jerome Powell is replaced or if he decides to resign voluntarily, the assumption is that the president will put in place somebody who's going to be very much in favor of lowering interest rates rapidly. Now, that person probably cannot act single-handedly, but he certainly will have an influence on the rest of the board. And one of the lessons of history is it never makes sense to oppose those in power. You know, the Lombards tried it and it was off with their heads. So I don't know about Trump, but and what's going to happen with Powell, but what reading between the lines, basically, we're hearing that if there's no call, if Powell does not resign, Mr. Trump will find a reason to fire him by accusing him of some wrongdoing related to the renovations of the Federal Reserve buildings. Now, you may remember, if we go back right to when we first started talking and the Federal Reserve was making huge profits, and I said, you know, it's gravy all round. They're making these billions of profit every week. And of course, they're paying the surplus to the Treasury. But when you're making billions, you know, it's Dolly Bird's secretaries, holidays, lunch canteens, new computers, new office chairs, luxury desks, you know. And of course, we're now hearing that was what was actually happening. Was it right? Was it wrong? I'm not judging that. I'm just saying it's bound to happen. When you're making a ton of money, you're going to spend some of it. And that's obviously what the Federal Reserve has done. And now Trump is saying that was perhaps a bit over the top. And maybe we have cause to fire Jerome Powell. So what would I do if I was Jerome Powell? I'd be quite worried. I think I'd be quite worried. Now, obviously, he might say, I'm sticking it out to the end. I can't be fired. And let's see what he does. But I wouldn't be that sort of person. I think I'd probably say, OK, the present leader doesn't like me. I can do better things with my life. I can live without being criticized like this. I'll just move on. So I think if I was Jerome Powell, I'd resign. But he has up until now said that he's not intending to do anything and he's going to sit out his term. But people do change their minds. And the pressure has been upped very, very significantly in the last week or two. So it could be that he's gone. Now, if he's gone, what does that mean? It means the successor is going to be a loose money person, in almost certainly, and the market will see it that way, and that will mean the melt up in which we're in the middle of a melt up. I mean, this is actually happening before our eyes. Almost all asset classes are rising to all-time peaks. That melt up is going to just continue and probably accelerate. I've read many great books by famous authors in my time. One of the most useful books I ever read was a book by O'Shaughnessy. I don't know if I've still got it. It's called What Works on Wall Street. And the conclusion of the book, it studies every strategy that's known to man in terms of investing, like following momentum, following price to book, price to sales, price earnings, momentum, and loads of other ratios, and combines them and looks at the conclusion it comes to is that one of the best things you can follow in stock market investing is to follow the price to sales ratio. And it concludes that companies which are on a price to sales ratio of below 1 tend to perform better than any other strategy that they studied. And they studied this was a study lasting, I'm just looking here, it seems to start in 1952 in my book and end in 1996. So it's quite a long study. So they conclude that a low price to sales below 1 is an attractive area to be buying, and a high price to sales ratio tends to underperform the market in the future. So you've just pointed out some stocks which have got very high price to sales ratios, and I would say that doesn't bode well for their future prices. We're talking over the long run, because here they were doing a measurement over something like 30 odd years or more. So those kind of stocks which are on these high multiples, high price earnings ratios, high price to sales ratios, I tend not to buy them myself either. I think I can find better value. I like to buy companies with growth, but I don't like to pay a lot of a high multiple for it. So I call that growth at a reasonable price. And that's not the only strategy I follow, but growth at a reasonable price basically means if I'm seeing something on a price earnings ratio of 25, 30, I'm bulking, even if the growth is high. Whereas if I've got a price earnings ratio of 15 or price to sales ratio of 1 or 2 with growth, I'm not bulking, I'm buying it. The biggest problem we've got going on now is all these graduates are coming out of university with their qualifications. They can't get jobs, and the reason they can't get jobs is because more and more firms are saying, "I can get an AI agent to do a job better than a graduate. Why would I take a graduate when I can, I can get the boss or the next line, the graduate's boss, to do 10 times as much work thanks to AI." So,
Yeah.
I'm hearing stories a bit everywhere now about young people who are looking for jobs in the finance industry, for example, and are finding that they're getting no real interviews at all.
Patterns often tell a deeper story, and silver's recent surge is no exception. Its rhythmic cadence of calm before the storm has once again played out, but this time, the context feels different. The backdrop isn't just technical, it's geopolitical and monetary. With the greenback losing its grip and new trade fault lines forming, silver isn't merely reacting, it's leading. Anchored by industrial strength and a monetary pivot, the metal is positioning itself as more than a speculative trade, it's evolving into a statement of strategic foresight. In a world where traditional currencies face increasing skepticism, is silver stepping into a new era as both an industrial powerhouse and a financial anchor? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.